If you want to learn how to start investing, this video is for you. If you have any questions or suggestions for future videos, please leave them in the comments section. Remember to subscribe, hit the bell, that way it notifies you when a new video comes out. So the question was, what stocks are good to invest in? So a bigger picture idea I wanted to cover in this is, how can you start investing and what should you invest in? And I had a couple of questions that I really need to ask because this is different for everybody. The first one is time. And the reason I ask for time is, are you talking about you want to invest in something and you want to pull it back out in under a year? Is it a 1 to 5 year time frame? Or are you talking that you're going to be able to let it sit there for 10 plus years? And if your answer is less than a year, you should probably not be in stocks. You should be in more something like savings, high yield savings rates, CDs, things along those lines. Because currently you can get about 2.5% interest, FDIC, so it's insured by the federal government, relatively safe in a bank, usually an online bank. Now remember, when I say safe, all investments carry some amount of risk. The more risk, the higher potential reward, but with that risk, what I mean is you have a higher likelihood of having a loss. Now, if you're in the 1 to 5 year range, maybe you want to look at CDs. CDs currently at the 5 year range are about 3.1, 3.3%. Now, if you're talking that you can wait and you don't need the money today, a year, 5 years from now, even 10 years from now, I think stocks are a great place for you. And the reason I say 10 years is because there's always these little upsets. And if you need that money and you have an upset, like what just happened in, let's say, December, people will panic and they'll pull out their money and they'll take a loss of up to 20%. And the people won't even get back into the stock market until the stocks have appreciated in value. So effectively, they sold low and they keep buying high, and that's a recipe for disaster. So if you don't have the conviction to leave it there, especially when there's a downturn, you shouldn't be in stocks. So if we go back through history, and I'm just looking at the S&P 500 ETF. Reason why I'm looking at the ETF is a lot of platforms allow you to trade ETFs without any commissions. Commissions or trades, transactions, eat into your profit. So if you can do it without having to constantly pay someone to make that transaction, that means more money in your pocket over time. So the last short downturn was about September through December of 2018. And the reason for that, there was a trade war going on. It was the end of the year. People like to sell before long weekends or holidays because they don't know what's going to happen over the duration of that period of time. Generally, people will sell off any non-performing stocks towards the end of the year. There's also tax write-offs and things along that line. And then generally you'll buy up new stock right at the beginning of the year for different portfolios. Also, there's rebalancing of 401ks and things like that that some people have automated every quarter or every year or so forth. So that's why it pretty much recovered pretty quickly. And there's low unemployment and things along that line. Back in 2007, 2008, down through 2009, it was the housing bubble crisis. Basically, you had people lending money to buy homes for people that would never be able to pay the loans back. So you could work at Burger King and you didn't have to prove your income. You could just state your income and say, hey, I want that $500,000 house. And they go, how much do you make? You could say $100,000 a year or whatever, even though they were making maybe say $20,000 a year. They also had adjustable rate mortgages, and they would just balloon the interest payment after a year or after 2 years or so of being in the house, or sometimes up to 5 years. And then Back in 2000 through 2002, you had the dot-com bubble that burst. So pretty much before that, if anybody had a .com domain name or anything, people were just investing in everything, even though there were no brick and mortar stores associated with a lot of those companies. So when they went belly up and burst, a lot of people lost their money in those individual stocks. So that being said, when someone asks, hey, what stock should I invest in? I'm not going to pick an individual stock because day to day everything changes. If you do have 500 large companies such as the S&P 500, they will over time perform pretty well. That goes back to what's your time span looking like. Over a 10-year period, you'll be able to recover most of the time anything that you have lost. SPY, which is an ETF of the S&P 500, is something that I also have in my portfolio. Another ETF that I use is the Vanguard Mid-Cap Etf, which is VO, and over the course of about 15 years, it's gone up from about $50 a share to $162 a share, so that's over 320%. So again, I'm selecting not a single stock, but rather a group of hundreds of stocks, so that I'm not picking an individual stock that might be affected by a specific event. I'm trying to have a diversified portfolio when looking at stocks and invest in hundreds of stocks. The nice thing about these ETFs is they also have a very low management fee, and when you have transactions, I know at least with TD Ameritrade, and I think Charles Schwab should have it, they have like zero commission, so there's no fees when you make these transactions as long as you don't go in and out of the ETF and you just buy and hold for a period of time. My only concern and warning at the present time is that I feel as though there's a high probability of a recession between now and 2021, and we could see very large losses in stock. A lot of very wealthy people are starting to pull cash off to the sidelines, which is common when they think that there's not good investments to be made at the current time. I would be hesitant to put everything I owned in the stock market at this point in time. I believe that the recession is going to be coming in the next couple of years, or at least by 2021. Generally, when that happens, you're going to see a major downturn. I'm keeping a considerable portion of my portfolio as cash or cash equivalents. And when there is a downturn, like a recession, you usually lose, say, 20, 30, 40% of the value of stocks. So what I'm intending to do is snowplow that money into stocks when I see that major downturn, because that's a buying opportunity. If someone said toilet paper was $1 for a 20-pack of Scott toilet paper, you'd be like, wow, that's a great bargain. If the next day it was $20 a pack, you'd be like, oh, I don't want to buy it. But for some reason, when we look at stocks, we think oppositely, or at least the general population. When they see stocks go from 20 to 10 to $1 or so, people panic and they sell everything because they think it's always going to get worse. That's when a well-trained investor will look at that company that is underneath that stock and ask themselves, what is the probability of that company going under, versus, hey, this is a great buying opportunity. Hey, look, it's 95% off. And they'll go and buy that, and they don't need to buy much of it. And when it returns to a higher value, that's where they really make their money. What are your opportunity costs? So what I mean by that is some people will say they'll invest in real estate, or they'll invest in something else, or stock, or whatever. If you invest in something, you have money that is sitting somewhere that you could have done something different with. You lose the opportunity to do something with the money if it's gone. Next question I have is, what's your risk tolerance? And what I mean by that is, can you afford to lose 20%, 50%, 100% of whatever you've invested. And that's going to also help guide you towards stocks, bonds, CDs, money markets, savings. If you can afford to lose, say, half of what you invest in any one short period of time, say over a 3-year period or over a 5-year period, and you can let it sit there for 10 years, stocks are probably okay for you. If you say, if I lost half of everything I had, you wouldn't be able to pay your bills, and you have no savings, and there's no way to come back, then stocks might be a bit too risky for you. And you might want to look into CDs. CDs you can get above 3% if you're looking at a 5-year term. Savings you can about 2.5%, or you can even look at treasury notes or treasury bonds. The risk with having low interest and low risk is that inflation could potentially outgrow the interest rate that you're getting on these products. So the interest rate that the Fed tries to control is around 2%. But if you look back in the 1980s, it went haywire, and they were trying to break inflation at any way they could, which basically meant they had to increase the interest rate to about 18%. So you also want to think about, is there any way to have tax advantages to an account? So if you're thinking about maybe retirement, or you don't need this money for a long period of time, I would urge you to take advantage of employer company match through 401k or 403b, or if you don't have that option, or if you want to save outside of a company account or that's not offered to you, there's individual retirement accounts, which are called IRAs, and each of these have a different flavor of, you can have a Roth or a traditional of them. And the difference between a traditional and a Roth is traditional, you basically don't pay taxes on that money today, and it grows tax deferred until you start withdrawal. If you wait till you're 59.5 years of age or older, you're going to pay tax on that money pretty much as if it was income. If you withdraw it before 59.5 years of age, you pay a 10% penalty. With a Roth account, you pay taxes today, and then you don't have to pay taxes on any of the interest or anything as long as you withdraw after 59.5 years of age. There was a little stipulation where if you kept the principal in the account for at least 5 years, you would be able to withdraw the principal but not the interest. If you make withdrawals of the interest or the principal before 5 years, you will have to pay a 10% penalty and pay taxes on any of the money you haven't already paid taxes on. Whenever you're thinking about investing, remember that investments can lose value. It's basically gambling. It's just you're calculating risk depending how you're doing it. You always want to make sure you have a liquid emergency fund. And what I mean by that, an emergency fund that's liquid, is money that you can get a hold of and you can pay your bills just in case you lost your job. And what I mean by a liquid emergency fund is that you need to be able to go and get cash within a couple of days or weeks in case you lost your job and you don't have an income. You need to be able to cover your expenses generally for about 6 months, because depending on how the economy is going, it might take that long to get a job. So once you have that emergency fund, you can feel a little easier in what you invest in. And that will also take away the risk of you withdrawing your money from, say, the stocks or anything when there's a major downturn. That's basically what happened to a lot of people in 2007 through 9, is that they were losing their jobs and they didn't have an emergency fund, and they were withdrawing from their 401ks at the worst time they possibly could, and that's when stocks plummeted. They were half the value that they used to be. So it's a horrible scenario. And that's when the rich made tons of money, because they bought things, everything was 50% off. or about 38% off, I should say. So what you want to do is copy what the rich do. Don't get mad, just do what they do. You want to be able to snowplow that cash towards that huge discount on all these major companies. And some may fail, but a lot of them will come back. So that's going back to, again, I don't want to invest in an individual company. I want to invest in hundreds of companies. So a question I had before was, what's the best broker? So if you're going to set up a traditional or a Roth IRA or a 401k or a 403b, or you just want to trade stocks, where should you go? Quick search on NerdWallet and a few other sites. TD Ameritrade is rated the best overall platform. The other one that I like was Charles Schwab. And if you're new to investing, I would suggest these two. The reason why is, number one, they actually do have brick and mortar stores. They do have people to answer your questions. They might be slightly more expensive in some of the commissions than their competitors, but you're getting a lot more hands-on help. And I know with TD Ameritrade, they give you a really good platform, and they give you a lot of in-depth research on every company that you can trade with them. They also offer commission-free ETFs. So Investopedia also lists Charles Schwab and TD Ameritrade. StockTrader.com lists TD Ameritrade as best overall value. The other stock trading platform I like to address is Robinhood. Now, Robinhood is a bit of a game changer. They have commission-free stocks. You can buy and sell stocks as much as you want. If you're not looking at a 10-year period to invest, and you're looking at, say, 1 year to 5 years, one of the best places you want to look is CD rates. So like I was mentioning before, you can get up to, they're in the range of, say, 2.7 to 3.4%, depending on what you have to deposit. And there's a lot of different places you can go for minimums. If you don't have that much money to start with, I would recommend Capital One. You can start with a 1-year CD at 2.7% and a minimum deposit of $1. I would suggest increments of $100 or a couple $100 at a time. I think they allow you to have about 50 different CDs open at any one period of time. When you have CDs, you might want to have a CD ladder, and what I mean by that is you could have a CD at 1 year, another one at 2 year, 3 year, 4 year, 5 year, so on. So that way you at least have access to that money every year, and when the 1 year expires, make that a 5-year CD, and then eventually you'll get to the higher interest rate. You might also want to try to break up some of the CDs. So let's say $500 per CD, you might want to cap it at that, just in case, say, your car breaks down. You might have to break that CD. There is a penalty to break a CD. It's usually about 3 months to 6 months of interest payments. So instead of breaking a single large CD, you could just break a smaller CD and not pay the penalty on all the money you have in the CDs. It would just be the one that you broke. It's roughly between 8 and 10%, depending on what the time period you're looking at. Inflation is also somewhere between usually about 1 to 3%, except for the 1980s. In the 1980s, it was in the teens. If you have an emergency fund, you still want to be earning interest, but you want to be able to get access to that money within a couple of days. So for that, I would suggest having generally an online bank. They'll pay about 2.5% currently, and that way you're earning 2.5%, and if the inflation rate is currently at 2%, you're still earning a little bit of interest on that money. A very common way to become a multimillionaire, or a millionaire for that matter, is to consistently invest money over a long period of time in, say, the S&P 500 or some other ETF that has a large number of companies, or a mid-cap or a small-cap ETF. And you want to make sure that you keep an eye on what are the commissions, how much money are they using as their expense ratio. Some of them I've seen at 1-2%, and others have been at, say, 0.01%. That will have a huge outcome on your ability to save over the long run. So the example I have here today is, what if somebody smoked 2 packs of cigarettes a day and they just decided to give them up? Or buying lottery tickets or anything, or drinking, or getting 2 cups of coffee or something along those lines. So if you were able to save $20 a day, $140 per week, that would be $7,300 per year. If you can get a rate of return of 7%, what would that look like? Now, this 7% is taking into account inflation as well. So if the S&P 500 has returned about 10%, and inflation is, say, 2 to 3%, you would end up with a rate of return of 7%. So when we look at all the values here, they're in today's money. So if you made this investment $20 a day, $140 a week, $7,300 per year, your rate of return, so we take 10% minus 3% for high inflation, we're at 7%. If we come down, if you did that for 34 years, when you retire, you would have over $1 million. Your initial investment would have come to a total of $255,000, and your investments will have made you over $750,000. The annual interest that you would be receiving if you continued at this 7% would be about $65,000 a year. So not that bad. But let's say you don't want to wait that long, and the income that you need when you retire is, say, $30,000. You could do this for 25 years and you'd be at $32,000 a year. So let's say you have an expense ratio of 2% versus me, who has someone that is next to nothing. So instead of 7%, you might only be getting 5%. At 5%, 25 years, you will only be getting about half as much as you would have if you just didn't have that 2%, because costs do compound. Now let's say we're only at 2% inflation and we were actually getting returns of about 10% or more. Then you would be at 8% for your rated return. To replace $30,000 of income, it would take 3 years less time to reach $32,000 per year if we go back to the 7%. What if you were able to save $25 a day? How long would it take you to replace $30,000 of income? Even at the lower interest rate, it would take you 22 years to reach your goal. So if there's any calculations that you want to see, I'd be glad to share them with you. I hope you found this informative and useful. Good luck to you and your families. The thing to focus most on here is it's not get rich quick. It's very achievable. It relies on being consistent. Remember, do your own due diligence. And if anybody says there's no risk, run the other direction. There's always risk in investments. It's just how much risk and what is your tolerance for that risk. If you have any questions or suggestions for future videos, please leave them in the comments section. Remember to subscribe, hit the bell, that way it notifies you when a new video comes out.